Okay, let's dive right in. Today, we're tackling a really important and honestly a pretty treacherous tax rule that every single investor needs to know about, the wash sale rule. Getting this right is absolutely key if you're trying to be smart about managing your portfolio. It's a tempting thought, isn't it? You've got a stock that's in the red, so you think, hey, I'll sell it, book that loss to lower my taxes. That's tax loss harvesting, right? But you still believe in the company long term, so you want to buy it right back. It sounds like the perfect trick. Get a tax break without actually changing your investment. Well, as you might have already guessed, the IRS is way, way ahead of you on this one. They look at that move and call it an artificial loss, and they've got a very specific rule designed to stop you in your tracks. And that rule has a name, the wash sale rule, or IRC Section 1091, if you want to get official. Its whole reason for being is to stop you from taking a tax deduction for a loss when, for all practical purposes, you never really got rid of the investment. So let's unpack how this thing actually works. The very first thing you need to wrap your head around is the timeline. The whole rule is built around this very specific window of time, and it's a trap that can catch even the most careful investors off guard. And here it is. This is the magic number you have to burn into your brain, 61. Everything, and I mean everything, revolves around this 61-day period. So how do we get to 61 days? Well, it's not just about what you do after you sell. The IRS looks 30 days before the sale, the day of the sale itself, and then 30 days after the sale. If you buy a replacement stock anywhere inside that 61-day sandwich, boom, you've triggered the rule. Now, this is super important because it's a huge misunderstanding. Most of the time, triggering a wash sale doesn't mean your loss is just gone forever. The IRS doesn't outright deny it, they just make you wait. It's a deferral, not a permanent disallowance. And here's how that works. That loss you weren't allowed to take, it gets added to the purchase price, the cost basis, of the new shares you bought. So what does that mean? It means when you finally sell those new shares for good, that loss is baked in. It will either lower your future gain or make your future loss even bigger. The tax benefit is still there, it's just been kicked down the road. Okay, well, let's move on to the next layer of this onion, and this is where things get really, really fuzzy. The rule applies if you buy back a security that is substantially identical. But what on earth does that actually mean? And that's the million-dollar question, right? Because the IRS very deliberately does not give us a clear black and white definition. Instead, it all comes down to a facts and circumstances test, which is just a fancy way of saying it depends. We have to look at examples to even begin to understand it. So this table really helps clear things up. Selling, say, Ford stock and then buying more Ford stock? Obviously, a wash sale, yes. But selling Ford and buying GM? No problem. They're in the same industry, but they're different companies. The really gray area, the one everyone debates, is with ETFs. Selling Vanguard's S&P 500 ETF and buying BlackRock's S&P 500 ETF is probably okay because they have different managers and structures, but it's not a 100% guarantee. The more similar the two investments are, the riskier it gets. Okay, so you get the timeline, you get the identical test, but now we have to talk about the real danger zones. There are two specific traps where a simple mistake can turn into a really disastrous tax problem. These are the ones you have to avoid at all costs. First is what I call the cross-brokerage trap. See, your broker, let's say it's Fidelity, they're only required to report wash sales that happen in your Fidelity accounts. They have no idea that you sold a stock for a loss there, then turned around and bought it back a week later over at Schwab. Neither broker will catch it, but the IRS holds you responsible for tracking this stuff across all of your accounts, even your spouse's. The burden is 100% on you. But as bad as that sounds, it's not the worst mistake you can make. Nope. The single most damaging, most costly wash sale error involves your IRA or your 401k. The IRS made this crystal clear in an official ruling. If you sell a stock for a loss in your normal taxable brokerage account, and then you buy that same stock back inside your IRA within that 30-day window, you've just triggered a wash sale. And here is the absolutely brutal twist. Remember how we said a normal wash sale just adds the loss to the cost basis of the new shares? Well, guess what? An IRA doesn't have a cost basis. So when that loss gets disallowed, there's nowhere for it to go. It just vanishes into a tax black hole. It's gone forever. You can never, ever claim it. This is the one wash sale you just can't recover from. All right, let's look at a couple of more advanced situations because the rules can be different for professional traders and they are changing super fast for new stuff like cryptocurrency. So, if you're a full-time professional trader, you can make a special tax election. It's called a Section 475 election. And if you qualify for it, it's like a golden ticket. The wash sale rule, poof, it's gone, doesn't apply to you. On top of that, your losses are considered ordinary, so you can deduct them in full against your income with no $3,000 annual limit. It is a completely different world from us regular investors. Now, let's get to the topic that's on everyone's mind. Crypto. For a long time, this has basically been the Wild West of tax loss harvesting. But that whole era, yeah, it's coming to an end very, very quickly. This timeline shows you everything. Right now, because the IRS says crypto is property, not a security, the wash sale rule doesn't apply. You can sell your Bitcoin at a loss and buy it back 5 seconds later and legally claim that loss. But this is a temporary situation. Starting in 2025, new reporting rules kick in, and brokers will have to report all this to the IRS. And almost everyone expects that soon after, Congress will close this loophole for good, putting crypto under the exact same 61-day rule as stocks. So let's do a super quick recap. The absolute essentials. 1. The 61-day window is a non-negotiable. 2. A deferred loss is not a denied loss, usually. 3. Substantially identical is a judgment call, so tread carefully. 4. You and only you are responsible for tracking wash sales across all your accounts. 5, and this is the big one, never, ever, ever rebuy a security in an IRA after selling it for a loss. And finally, that crypto loophole you've been hearing about? Yeah, it's on its last legs. And that kind of leaves us with one last thing to think about. We're moving into a world where every single transaction is digital and instantly trackable. So is that going to lead to a simpler, more streamlined tax code for everyone? Or, like we're seeing with crypto, are these new assets just going to create new rules, new complexities, and new traps for all of us to navigate? Definitely something to chew on. Thanks for tuning in.